What are preferred convertible shares? Well, preferred shares by their very nature grant a preference to the holder of the shares above common shares. So most founders of a company are going to create the company with common shares, and thus the shares that the founders hold are common shares. When they later seek investors, or outside investors are willing to purchase an interest in the company, those investors are going to want preferred shares. Now, these shares can have any number of characteristics. One of the most common characteristics is conversion. That is, these shares can be converted at a predetermined formula. This is subject to negotiation between the investor and the common shareholders, but converted into common shares, and there will always be a predetermined rate and some aspect of dilution integrated in there. So one preferred share may be converted into 1.25 or 1.5 or 5, whatever the number is, common shares. And there will be a calculation in there for if additional common shares or other preferred shares have been issued later, thus diluting the total number or amount of common shares out there existing at the time. There may be a provision that says, well, it's fully diluted. That is, there's a conversion based upon all of the options, all of the preferred shares that can convert back to common shares, that the conversion rate is based upon the fully diluted number of shares. There may be anti-dilution protections built into the preferred shares stating that any additional common shares or any preferred shares that are convertible into those common shares, those will not affect the right of the preferred convertible shareholder. That is, they can convert their preferred shares into a certain number of shares based upon the number of authorized or outstanding, whichever, shares were present in existence at the time those preferred shares were issued. So basically, they are not subject to dilution. So all of these are characteristics that you could incorporate into the preferred convertible share. Now, voluntary versus mandatory conversion. These are two unique concepts applicable to convertible shares. Voluntary conversion means that the investor or holder of the preferred share has the right to convert those shares into common shares. It is their election. Mandatory means that these investors are forced to convert into common shares based upon the terms of conversion. The voluntary conversion, as I stated, is based upon the convertible shareholder's preference. Mandatory conversion is generally when you have some sort of liquidation event. That is, the company is being sold or completely refinanced or restructured. In those scenarios, there'll be provisions in the shareholder agreement or investor rights agreement stating that there is mandatory conversion of the preferred shares into common shares, because this can make a liquidation or a sale or a public offering of the company extremely difficult, or in the case of a public offering, sometimes not legally possible or not acceptable to exchange regulations. So with that being said, it is important to have those provisions in there about mandatory conversion in specific circumstances that may arise, that having those preferred shares out there would thwart the growth or ability of the company to follow that course of action. So that's what preferred convertible shares are, and those are some of the primary considerations or provisions applicable to these types of shares.